Dombrovskis to give his key note. I would like to thank him very much on behalf of the ESRB, of President Draghi. Mr. Vice President, would you have also time to take 2 or 3 questions? Thank you very much. You have the floor.
Ladies and gentlemen, it's a pleasure to be back for a second time in the ESRB annual conference. This summer marks the 10 years since the beginning of global economic and financial crisis. And at this turn, we can look back and appreciate that we have put crisis firmly behind us. EU's GDP per capita exceeds pre-crisis levels, and Europe's economy is expanding for a 5th year in a row. Today, unemployment is at its lowest level since 2008, banks are stronger and better capitalized, and public finances are in better shape. This shows that our policy mix of investment, structural reforms to strengthen competitiveness, and responsible fiscal policies is working. With the help of European Fund for Strategic Investment, we have already mobilized investment corresponding to more than 225 billion euros. And we have taken decisive action to make our financial sector safer and address the shortcomings of the initial setup of our economic and monetary union. We need to continue along this path. However, challenges remain. Levels of public and private debt are still high, productivity growth is lagging, and our economy needs more long-term investment. There is a worrying slowdown in the momentum towards international regulatory cooperation. While major systemic risks of our financial system may have receded, dispersed problems remain. One example is high levels of non-performing loans in some member states. The Commission is working to address these risks. We want inclusive growth and economic recovery that benefits everyone. In today's speech, I would like to briefly touch on the macroeconomic situation and non-performing loans in particular, then turn to yesterday's proposal for a review of European system of financial supervision, starting with macroprudential aspects and ending with macroprudential aspects. So let me begin with macroeconomic situation. As I was saying, European economy is growing steadily and many indicators are moving in the right direction. This positive outlook has now broadened to include all EU member states, which shows that our policy mix of broadly neutral fiscal stance and accommodative monetary policy is delivering results. The improved regulatory and supervisory framework, as well as recent increase in bank funding, have likely contributed. That being said, we cannot afford to be complacent. First of all, the current climate for international regulatory cooperation is unpredictable. Now that the crisis has receded, we need to ensure that the progress that has been achieved in regulation is not unraveled. I'm strongly pressing this because the financial crisis illustrated the international nature of our financial system. Only with a common approach to the financial regulation can we ensure a level playing field of our financial institutions and minimize the risks of regulatory arbitrage. And second, idiosyncratic risks are waiting on the recovery in certain member states. High levels of non-performing loans in certain national banking systems are a prominent example. This is particularly an issue in Greece, Cyprus, Italy, and Portugal, but other member states are also affected. By increasing funding costs, these NPLs negatively affect the resilience of the banking sector to shocks and weighs on the recovery of the wider economy. There is also the potential of spillovers to other countries given the high interconnectedness of EU banking system. Based on historical experience and current trends, if we do not accelerate the NPL cleanup, it would take another decade to resolve the legacy of NPL stock. With the action plan adopted by the Council in July, we now have a clear political commitment to address non-performing loans. This plan comprises 14 policy actions in 4 key areas. supervisory policies, structural and legal reforms, including insolvency and law enforcement frameworks, fostering of the secondary market for NPLs, and support for restructuring of the banking sector. The European Systemic Risk Board, alongside with other key actors at the national and EU level, will play an important role in this plan. On our side, the Commission is determined to support this action plan. We now have our public consultation running on fostering secondary markets for non-performing loans and on possible legislation on secured creditors. The support of European Parliament Council will be crucial in delivering these steps, and we are working together with ECB, European Banking Authority, and ESRB to develop by the end of the year the European blueprint for national asset management companies. More financial integration and deeper capital markets will also be helpful for dealing with these scattered risks. We need to consolidate the ongoing trend of financial integration by completing EU's two flagship projects of Banking Union and Capital Markets Union. In the coming weeks, the Commission will set out some ideas on the way forward for the Banking Union, and with a mid-term review of the Capital Markets Union in June, the Commission raised its level of ambition for completing the single market for capital by 2019. More financial integration will support jobs and growth by increasing the pool of capital available for productive investments. It will benefit market users thanks to increased choice and competition, and it will help guard against the effects of financial shocks, thereby reducing the need for public intervention. This is a key for more resilient economic and monetary union. Now moving to the review of European supervisory authorities. Yesterday's proposals link directly into this. We have put forward target amendments to improve the ability of European supervisory authorities to monitor cross-border risks, ensure supervisory convergence, and adapt to the new developments on financial sector. The proposals we have made fall under four broad categories. First of all, we are upgrading the supervisory convergence tools of the ESAs and giving new responsibilities to the EU-wide Supervisor for Securities and Capital Markets, ESMA. Today, there is almost no EU-level supervision of capital markets. Our proposal would expand EU-level supervision in areas where common supervision is easier for firms operating cross-border and more effective for supervisors. This includes certain new prospectuses, EU-labeled cross-border investment funds, and services of systemic importance such as critical benchmarks and data reporting service providers. Second, we are improving the governance and funding of all three ESAs. Our proposal will create new executive boards with permanent members for quicker and more EU-oriented decision-making, and it will make the ESAs financially independent of national supervisors by introducing proportional contributions from the financial industry. Third, we are proposing changes to improve the coordination of supervisory authorities and minimize the barriers to cross-border financial services. This would be achieved by having the ESAs to set out EU-wide priorities for supervision and perform rigorous and independent reviews of the national supervisors. We are also reviewing supervisory relations with the third countries to ensure proper management of all financial sector risks. And last but not least, we want the ESAs to promote sustainable and green finance and fintech. This is why we want to require them to take these areas into account in their work. In my speech at the last year's ESRB conference, I highlighted the major progress we have made in establishing an institutional and regulatory framework for macroprudential policy in Europe. Today, the evidence shows that the ESRB is already playing an important role in safeguarding financial stability in Europe. For example, last year, the ESRB issued public warning about vulnerabilities in the residential real estate markets in 8 member states. These warnings contributed to discussions and improved knowledge on the topic. On the Commission side, we are integrating ESRB's analysis and recommendations within our work in the context of the European semester. The ESRB has also done substantial work to coordinate macroprudential policies and their consistent implementation. Together with yesterday's proposals to strengthen the three ESAs, we also proposed to amend ESRB regulation. Overall, the Commission is satisfied with the functioning of the ESRB and its contribution to the financial stability in the EU. The ESRB is a relatively young body and its work has been improving since its creation. In particular, it has managed to effectively use the resources and expertise provided by its broad institutional membership. In this work, ESRB has acted as hub, supporting the balance of centralized oversight and decentralized implementation of macroprudential measures. In reviewing the ESRB, our objective has been to maintain this balance. We want to preserve and build on the existing framework. Accordingly, our proposal is one of targeted changes to the ESRB's governance. As ESRB chair, the President of the European Central Bank has conferred authority and credibility of ESRB and ensures that ESRB can effectively build and rely on ECB's expertise in the area of financial stability. We therefore propose that the ECB President serves as ESRB chair on a permanent basis. At the same time, we propose to enhance the standing of the head of the ESRB Secretariat by making the appointment procedure more transparent and by specifying and clarifying his or her tasks, including the possibility for the chair to delegate the task of representing ESRB externally. As a large assembly, the ESRB General Board benefits from being inclusive and combining a range of cross-country and cross-sectoral expertise. To reflect the establishment of the banking union, we propose adding the SSM and SRB as voting members on the General Board and on the Steering Committee. We also propose to ensure that ESRB can issue warnings to the ECB when it comes to banking supervision. This would correct the current asymmetry between national and the banking union level in this regard. Our proposal also ensures that European Parliament and the ESAs would be systematically notified about the use of these tools. We trust that these changes will allow ESRB to carry out its mission even better than it has done since its establishment in 2010. So let me conclude. The package of proposals that we proposed yesterday seeks to make improvements where necessary without upsetting the balance that proved to be functioning. At the same time, it's ambitious in seeking to enhance the ability of the ESFS and ESAs in particular to play a key role going forward. So we are looking forward for constructive discussions on those proposals. Thank you very much.
Where is the micro?
Perhaps I can ask. Thank you for a very good speech and your insights. Thank you. Thank you for your very good speech. And my name is Pentti Hakkarainen from ECB. You took up also non-performing loans and that problem, and also some initiatives made to solve the issue. My question is, when public authorities are now entering that field more strongly, what is the role of the banking industry and the banks? What is their responsibility to clean the mess? Thank you.
Okay. Well, I would say it is primarily the responsibility of the banking industry, and that's exactly where our proposals are heading. When we are discussing the for example, the supervisory action, it's exactly supervisory action to stimulate banks to address the NPLs issue more actively. When we discuss the framework for secondary market of NPLs, we just note that in several countries, for example, this is quite restrictive. Even if banks were willing to dispose of NPLs, sell them on the secondary market, often they are facing quite substantial administrative obstacles for doing so. So this is the element which we can address. When we are discussing national asset management companies, what we are doing, we are now preparing blueprint how to do it within existing state aid and banking union rules. As we know, banking union has been created with the aim to reduce taxpayers' burden for dealing with the financial sector problems, and this point remains valid, and this point remains while we are preparing proposals and action plan how to deal with NPLs.
Maybe I can ask one question. It's something which we have been discussing with the colleagues of the Advisory Scientific Committee at lunch last night. It is about the fact that we achieved a very high degree of financial integration until 2006, and then we experienced a very deep process of financial disintegration. Now things certainly are going better, but my question is, seen from Brussels, what has been impeding the fact that some big banks, for example, would come to countries like Italy, use the passport, enter the country, conquer the market, and to a certain extent wipe out the non-performing Italian banks? This would have been a fantastic proof that the single market wins over the crisis.
This exactly is our aim when we work on initiatives like Banking Union and also Capital Markets Union. One of the aims is to remove cross-border obstacles for doing banking. It concerns regulatory obstacles, because what we had been also observing with our system with EU passports, that often countries are still, so to say, gold-plating the requirements, and banks and other financial market participants are still not feeling themselves like in a single market, but rather still dealing with different national markets. So it's addressing those regulatory obstacles, which is often impeding for this cross-border finance. Of course, since the crisis, one of the obvious reasons was also increased risk averseness, as banks were removing and sometimes actually kind of urged by their supervisors and regulators to consolidate, to return to their core domestic activities instead of being active in other EU member states. We had also seen this as a response to the crisis, so this is another element which we need to address within the banking union, capital markets union. Currently, we are looking also on how to create enabling framework for fintech industry, whether also some EU passports in certain activities, like, for example, crowdfunding or peer-to-peer lending would be necessary to allow also fintechs to scale up in Europe instead of starting in Europe, not being able to scale up, and then moving to US or Asia and scaling up there and competing from there. So there are a number of elements which we need to work with. So it's both regulatory elements, supervisory practices, risk averseness of the banks themselves, and indeed this increased financial sector integration in Europe is one of the aims of both Banking Union and Capital Markets Union.
Thank you very much. The last two questions,
The
please.
Commission probably achieved one of the highest success in the financial industry with the UCITS directive. Basically a blueprint that is copied around the world from Latin America to Asia in how to run mutual funds. But they have one constraint, liquidity daily, if not 2 weeks. 99% of UCITS have daily liquidity. Now, because European companies, non-listed, account for 80% of jobs, so basically company not listed, they cannot benefit out of the UCITS directive. Is there any work the Commission is doing to create like a UCITS type platform, but for funds which can invest in non-listed company because they represent 80% of European jobs?
Well, I would say currently we are rather concentrating on how to facilitate that companies get listed. When we are, for example, simplifying prospectus requirements, which has been already been done, when we are creating those SME growth markets and so on, we are creating a framework how more companies can be listed and how companies can actually raise more finance from the capital markets. So that's, I would say, currently the main direction of work which we are considering instead of other way around.
And the last question?
Yes. I'd like to ask about the Commission's proposals regarding the ESRB, its enhanced authority in certain areas. In the proposals, is there any recognition that the ESRB should, in the future, evolve to be a more powerful macro-prudential supervisor in the European Union? And I guess I look at the issue concerning the fact that now it can only issue recommendations and warnings, but it has no real legal power to back up any of its work it's been doing. And if it does not, do you think there's any type of asymmetry with the European supervisory authorities? You've discussed how you've enhanced their institutional structure a bit more, and they will have greater powers and be more independent of national authorities. And do you feel that the ESRB framework should be more symmetric with the ESAs?
As I was telling, on our proposals for ESRB, we were acknowledging that actually ESRB has been for a good start of this work. So we are not overhauling the framework. We are coming with some targeted changes in certain areas. In governance, we are extending areas where ESRB can also issue warnings, including to the ECB, to correct also, as I was saying, some asymmetry between national and banking union level. And we also give more visibility for ESRB to ensuring that European Parliament, ESAs, are more systematically notified. So those are the main changes we are currently introducing. So we're not introducing some legislative powers at this stage.
Mr. Vice President, thank you very much for having been with us for the second time. It's a great honor. I have now the good news, and I'm pleased to invite all of you to a reception which is taking place in this direction. Tomorrow at 8:30 we are starting with a welcoming address. It will be me who will be welcoming you. I will tell you about the work which we are doing in 4 areas. You will see that the fact of having soft law powers also enables you to speak and think about many issues. I will speak about commercial real estate, investment funds, CCPs, and other issues. Thank you very much. Thank you very much to the Vice President of the European Commission, and I would like to invite all of you to the reception. Thank you. Bye.